Welcome back, Joseph.
Oh, hey Dale. Hey Blake. Hey
Hey,
everyone. Thanks so much for
Good,
inviting me. It's a pleasure to
good
be here. Can
morning,
you hear me?
Joseph. Good to
Hey,
hear you.
Joseph.
great to have you back, Joseph.
Okay,
And
Dale and Joseph, behave. We don't want you to give out too much today, right? hold some back
oh,
for
okay.
the event.
All right. Well, this is a rehearsal. Okay. So, Joseph, great to have you back. I'd like to start with when we first met and I started being aware of your work. At that time, you were talking about the great steepening, right?
Yes,
I,
yes. Looks like we
okay.
inverted since then.
That's what I mean. So okay, it turned into instead of the great steepening into the unexpected inversion. Um, could there still be a great steepening, and it happens when rates go the other way, that there'll be less confidence in the long end, and that's when the steepening takes place?
So this is how I'm thinking about the shape of the curve going forward. So
Okay.
one thing I also noted earlier in the year is that the 10-year would go up to 4%, and surprisingly, it did. So I think of 10-year longer dated yields as really just determined by supply and demand. And if you
Okay.
looked at the supply and demand dynamics, it was really clear that the longer yields would have to go higher, and maybe
Right.
significantly so. So at a high level, the supply dynamics are just incredibly bearish for the treasury
Yeah.
market. So right now, the US government is projecting about $1 trillion in issuance every year forever. And just for some context, before COVID, they were issuing about $500 billion a year. So it's a much higher pace. And if you go back 10 years, you'd actually have people who would worry about things like the deficit, but all those people, they're gone
Sure.
now. So we're full speed ahead and we're just issuing a lot of debt. And you add on top of that QT. What QT does at a high level is it increases the amount of treasuries that the market has to absorb. So you
Right.
got the
More supply.
treasury. So you have the treasury issuing $1 trillion a year, and you also have QT issuing adding several hundred billion as well. So with all that supply coming online, and the marginal buyer until recently was the Fed and the commercial banks, and so they're all stepping back. And so based on that, it seemed to me that it was quite clear that we would have higher, longer dated yields, and that has come to pass. We're above 4%
Yes.
now. But I think we're at this place now where I'm a little bit more unsure if we will continue to go higher. Now, again, those supply and demand dynamics. Oh, well, Liz Truss resigns. Okay, just breaking headline
Yeah.
just for you guys.
Yeah, that's what's
So,
happening there. So
so,
I'm wondering, are we any
so
different
I'm not finished
than
yet.
the UK?
So usually these supply dynamics would continue to suggest that yields will go higher,
Yeah.
but there are other things to consider as well. When your yields go higher, what that really means, another way you can look at it is that people who own these assets, they're losing money. And when they lose enough
Big
money, they eventually get things like margin calls or they have solvency issues.
Yeah.
And we see that happening. We saw that happening with the pension funds in the UK.
Right.
So
Is
in
the
the
US
UK,
any
what
different,
happened? So
Joseph?
in the UK, so Dale,
Is
give
the
me a
US
moment.
any different than the UK when it comes
Dale,
to that?
let me finish and I'll get to
Okay.
that. So what happens is that eventually, when the yields go high enough, then people have some solvency issues and then bad things happen. The thing about the bond market, though, is it's globally connected. So when you have US yields rising, it pulls up the yields in the rest of the world. And, well, on the same way, though, you have supply and demand dynamics who are also bearish for bonds throughout the world. So eventually, something somewhere cannot withstand these higher yields and things snap. And then the authorities come in and they try to restore order to the system, which is what the Bank of England tried to do. So the Bank of England but if you'll notice when the Bank of England stepped in and they started buying, that also put downward pressure on US treasuries as well, because the global bond market is connected. Now, going back to your question, Dale, the US is not super different, but I think our financial system is a lot stronger. the way you can see this is if you look at a basket of, let's say, US bank stocks against European bank
Okay.
stocks.
Good
So
point.
if you look at whatever happened since the great financial crisis, well, all our US bank stock, the stocks of, say, JPM City, they've all surpassed past highs and then, gone higher. The European bank stocks have not done very well. If you look at DV, it's, over the past few years, it's just kind of gone nowhere. So they are a lot weaker. And if you hear market chatter about things like CDSs of DV or Credit Suisse, it's all the same. So they are in a much weaker position than the US is. So as global yields go higher, I think that even though the US is not, they're a fault of the US is relatively stronger. And because it's relatively stronger, when something happens, when something breaks, it's probably going to be in the Eurozone or somewhere else
Okay.
that will force their authorities to act. And so that actually means that there's less, less impetus for the Fed to act and also downward pressure on yields. So when I see this, even though I think that the supply and dynamics dictate that, yields will go further higher, I think somewhere along the way, the authorities will step in and kind of either slow this down or stop it, kind of like what they do in Japan.
Okay. So you're talking about that on one of your tweets that there'll be a central bank put on
Yeah,
bonds because of solvency issues.
yeah, exactly. That's right.
Okay.
So,
Go ahead.
yeah, so for example, so let's say you're a big asset manager, like a pension fund, you have assets and you have liabilities. When the bond yields go higher, that's your bond prices going lower. If you have a little bit of leverage, and if you're a financial sector entity, you always have leverage, right? If you're a bank, you
Yeah.
have leverage. If you're a hedge fund, you have leverage. Very few big players don't have any leverage. That mismatch between your assets and your liabilities, and not everyone has to mark to market, but some people do. That might create some pressures. So
Okay.
we have this. So people talk about the level of the debt in the system is very high. I look at it as that's the potential losses that would happen if yields continue to go higher. That is to say, the prices of debt continue to go lower. You're basically taking money out of the financial system, but the losses are unevenly distributed, such that perhaps someone is not able to bear these losses. And when that happens, they'll have to sell to make their margin calls. When they sell, that makes the asset prices go even lower, and perhaps other people will have that same problem as well. So that's the fragility that I think we see, and I think the authorities are aware of right now. So that's
Are they going to come in? Is the Fed going to come in? And before we get to that, you talk about us being stronger, yet at the same time, there's no central bank cooperation. Yet at the same time, the Fed is doing swaps with Credit Suisse, which is not a U.S. bank. So if the crisis happens in Europe, the Fed's going to be involved anyway. Isn't that going to be more costly than coming in with a solution like the bond put that you're talking about? And isn't there a solution with the dollar being the wrecking ball? I've been talking about this for a while, to stop the ascent of the dollar, which may be stopping on its own, but to have some type of concerted intervention, because isn't part of this bond problem a dollar liquidity squeeze?
So that's a lot there to unpack. Let's go by it one by one.
Yeah.
So the Fed is, in a way, the central bank of the entire world because of
Right.
those swap lines that you mentioned, Dale. So let's
Yeah.
say that there's a bank somewhere in Europe or maybe in Japan who has some dollar liquidity issues. Now, if a bank has dollar liquidity issues, usually what happens is that it goes to the lender of last resort, the central bank, for an emergency loan. But if your issues are in dollars rather than your home currency, well, that's a problem because the Bank of Japan or the ECB or some other foreign central bank cannot print dollars. So that's where the Fed steps in. The Fed has these swap lines where what it does is it acts as lender of last resort for basically the global banking system. So if that bank in Japan or in Europe suddenly needs a dollar loan, what they'll do is they'll borrow from, let's say, let's just use the example, a French bank. The French bank would borrow from the ECB, and the ECB would then borrow from the. So in that way, dollars flow from the Fed to to the ECB and then to the French bank. Now, what we see right now happening is that the Fed has some loans to the Swiss National Bank. So presumably there are some Swiss commercial banks who need dollars. So the Fed is lending to the Swiss National Bank, who is lending to the Swiss commercial banks. Now, some people think that this may be a sign of some stress in the system, but there's another way to look at this as well. This has happened before, and Zoltan Pozsar, who is one of the preeminent strategists in this area, a strategist at Credit Suisse, has written about this in the past. Now, one thing to note is that in the past, what has happened is that these small Swiss banks, well, some of the smaller Swiss banks, what they do is they borrow dollars indirectly from the Fed, swap them into Swiss francs, and then deposit those Swiss francs at the Swiss National Bank to earn interest. So it's not that they need dollars. What they're doing is an arb trade. So usually around, let's say, the fourth quarter every year, there's some pressure in the funding market. This has to do with regulations. So when that happens, some banks would try to take advantage of the cheaper dollars the Fed provides and use that to just make some extra cash by arbing interest rates. So it's not that they need dollars; it's that they just want to earn a little bit of extra return from doing this trade.
So is the dollar not being appropriately labeled when it's being called the wrecking ball of the global economy?
So the dollar is definitely exerting some very strong deflationary effects on the world. And the mechanism through which this acts is the fact that there are many foreign corporations who take out loans in dollars. Now, let's say that you're a Japanese corporation and you borrowed $100 million US dollars. Okay, you have a $100 million US dollar loan, but then you see your currency depreciate from 100 yen to, let's say, 150. Well, that means, and if you're earning money in Japanese yen, then that means your US dollar loan just became much more difficult to pay off. Effectively, your dollar loan became much more expensive. It grew a lot. Now that makes it difficult for the Japanese company. It's equivalent to having, you can think of it as if you borrowed $100 million and you end up owing $150 million because of the currency difference in effect. So that obviously is a drag on that corporation, makes it less likely to be profitable, to expand, and so forth. And that happens at a global scale because there's a lot of dollar
emerging
loans
market debt, etc.
But I think there's two things you have to keep in mind as well. One is that oftentimes these corporations, they do hedge their exposure, so they don't really fully bear the brunt of this. And the other point is that if you're a company taking out dollar loans, usually you also have dollar revenues. So, for example, let's say you're an oil company who took out dollar loans. Yes, maybe you're based in the Middle East, but your revenues, your income is also in dollars. So you're hedged that way as well. So it's not so not everyone is hedged, but I would say that it is not as bad as it appears to be.
Okay. All right. So a weaker dollar, would that take some of the pressure off this liquidity squeeze that we have going on in global bond markets? And if the dollar continues to move to higher highs, does that exacerbate what we have going on here with your worry about solvency? And when will the Fed come in with a put on bonds? We're getting close to some technical levels where there could be a recovery. Are we near the time where they're going to come in here and try and stabilize the bond market like the BOE did? Is that the put you're talking about, a central bank put on bonds?
Yeah. I'm gonna have to defer to you guys about the technical levels.
Yeah.
I sense my sense is that they are getting concerned, and that there are some tools that they can do to kind of slow this down. But again, my thinking still was that the ECB and the Bank of England and maybe the Bank of Japan should be a lot more worried. And when they
Okay.
do something, the Fed has to do less because the global bond markets are connected. If
Yeah.
they can slow down the rising yields elsewhere, that also slows down the rising yields here in the US. Now, if they wanted to stop the rising yields, there are a few things that they can do. Most obviously, they could do some form of QE. I think that's very unlikely. They could do some form of yield curve control where, let's say, uh, the Fed
Like
says, I'm
Japan?
willing to. Yeah, but except one where it's less of a binding ceiling. For example, let's say that the Fed is willing to buy every treasury, 10-year treasury that yields above 5%. So setting the cap at 5%, such that it's more like an emergency liquidity facility rather than a binding cap like it is in Japan.
Yeah.
I think that's sometime in the future as well.
Why
What the
don't they just
authorities
sell dollars and make the dollar the sacrificial lamb as a band-aid for this emergency?
Because, well, so I think it's really important to make a distinction between the spot price of dollars and dollar funding rates. So if you have a squeeze for liquidity for dollars globally, it doesn't actually manifest in a dollar spot price. That's not how funding happens. If you're a corporation abroad and let's say you're a Japanese corporation, again, the $100 million loan, suddenly you can't pay your loan back. What you try to do is you try to roll it over. What you don't do, well, maybe you could default to what you don't do is you take your last liquidity and you go, try to buy everything in the spot market. That doesn't make any sense.
Okay,
So
so like what the BOJ did with spending 1% of their reserves and they haven't backed it up. We're above their first attempt at intervention, but couldn't concerted intervention between BOE, BOJ, and the Fed work like it did in the Louvre Accord or the Plaza
yeah,
Accord? I
yeah,
mean,
yeah, I could, but that misunderstands the Fed. The Fed wants a stronger dollar, and they've been very open about it. If you listen to Chair Powell as
yeah,
speaking before the Senate and House committees, he'll tell you straight up that one of the ways that monetary policy works to get inflation lower is to strengthen the dollar.
right,
So
right,
that's what he wants. There's no reason to do no Plaza Accord if I mean, because they don't
right.
want a weaker dollar, right? So
Okay.
so they
Uh,
this move in the dollar is blessed by the authorities. So
yeah.
you don't
But
really
if
have
you
to.
look
I
at
don't
the bond chart, they're the opposite. Look at this, and then look at this. So if you want to stop this, why not stop this?
because you don't want to stop either. You want yields to go higher, and you want the dollar
Yeah.
to go higher. That's how monetary
Okay.
policy works to
Okay.
decrease inflation. So
Okay. And so they think
everything
they could
is
do that without creating the solvency issues that you're worried about.
So I think they're beginning to get worried because they don't really know where that point is.
Yeah.
So far things are going, I think, as they expect, and you can hear that in their speeches as well.
Yeah.
They are happy, and Jerome Powell is also very happy that the equity market declined a bit.
Okay.
But eventually, you can't keep rising forever. There's a limit there, and that's what I'm talking about. There's a limit as to how high yields can go before you incur some very serious financial stability issues. And I
Right.
think we're getting close to that point, which is why I think that yields are
Close to peaking.
close to pausing. I don't know about peaking, but
Pausing.
close to pausing. I think the bigger picture is yields continue to march higher, but maybe we have to pause it a little bit. We've gone straight up for a while, haven't we?
Yes. So, this brings us to what you're talking about now, Joseph, and a lot of institutions have lost credibility, and you're talking about, I mean, most Americans don't believe that Congress is functional anymore. The medical system, just a lot of institutions that we've relied on for generations, which includes the Fed. And you're beginning to worry that people people are asking, why do we even need a Fed? And that their confidence in the Fed is decreased markedly. So the Fed really needs to pull this off, because if we have a very hard landing, don't you think that's only going to accelerate the mistrust and people saying abolish the Fed?
Yeah, I think so. I mean, so politically, so there's actually, you raise up a really interesting question about confidence in the Fed. So if you're the Fed and if you're a PhD economist, you think that a lot of the reason inflation has been low in the past is because of confidence in the Fed. Because the Fed believes in something called inflation expectations, which is not unreasonable. So the thinking is that if people expect inflation to be, let's say, 10% next year, they'll go out and they'll buy stuff today. And if they do that, that makes inflation higher because everyone goes out and buys stuff today, pushing prices higher. So a big reason from their thinking that inflation has been low is because people expect inflation to be low. And why do people expect inflation to be low? Because, well, the Fed is going to do its job and keep it low. So
Okay.
that's
Yeah.
kind of how they think about inflation expectations. The funny thing is, though, that people who do these surveys to the broader public and ask them, so, what do you think about the Fed? Do you have confidence in Fed? And what do you think about inflation? And the majority of people have no idea what the Fed does. And so confidence in the Fed really can't be, you can't say that
They only,
inflation is
how
low
can you
because
have confidence if you don't know things exist?
exactly.
Right.
So
Right.
that's kind of, I don't know, that's, so there's a big gap between how academic economists think about the world and, in my view, how the world actually works. And the gap is really wide. And so they have all these bizarre ways of, thinking about the world. But yeah, so I don't know if Fed confidence is all that important, but the public definitely does not like high inflation.
Yeah.
And there are people who don't like the Fed. And I think we'll use this opportunity to try to take away the Fed's independence. We see whispers of that already, and we see whispers of that in the UK as well. And it's not unreasonable, too. So we gave the Fed independence because we wanted it to be able to do its job without political interference. We were afraid that whichever party is in charge would use the Fed, who has a money printer, to further
Right.
their own games, right? So
Right.
we don't. That's why we gave the Fed independence. We want them to be above that and take care of inflation, or is another way to think about it is the value of our currency. But the Fed has shown that it's not able to do their job. Inflation is 8%, and maybe it won't go down to 2% for some time. Now, if the Fed is not able to do its job, then maybe there's no reason to have an independent Fed. So I think going into the future, we will have people who will try to take that independence away, and as justification say that the Fed is not doing its job; it needs to have more oversight, and that could be something in our future. And if that happens, I think inflation will probably get much worse because the trend in politics seems to be to
Spend.
spend a lot. So
Yeah.
to win elections, back then people would joke that eventually people would realize that you could just vote yourself money, and then that would kind of be the end. And we're kind of there already, it seems. And taking away the independent Fed accelerates that transition. But that's something I think still in the future, not imminent.
Well, I tell you what, I'm rooting for Jerome Powell to pull a Sully and land that aircraft on the Hudson safely
I
with all of
I
us on
you know
board.
I'm a fan of Jerome Powell. I think he's doing the best he can. So I hope he does well as well.
I'm a fan of Joseph Wang. And yeah, if you want to learn about what is so esoteric, and I talk about it, but it's like me talking about Elliott Wave. I'm an amateur. If I didn't have a chart, I wouldn't be able to steer my ship. So if you really want to learn the nuts and bolts of the Fed, check out Joseph's website, and you could follow him on Twitter at FedGuy12, and come listen to him this weekend. I believe K-Man's going to be interviewing Joseph, and really appreciate your time. Every time you're here, you edify me. I learn from you, Joseph, and I'm sure that our audience does too. And here's to solvency.
Thanks so much, and I
I'm
really
all-
look forward to this weekend. I think it's going to be great. Very impressed by your program. It looks like you got a really, really good roster of people, and I'm flattered to be among them.
Yeah, great to have you. Thanks for agreeing to it, Joseph Wang, everybody, and thank you, Joseph. I'm all for them coming in to stop yields, and you know me, I want a dollar bear market. I want a dollar bear market. I think that a weaker dollar would go a long way to kind of calm things down. So thanks for answering my nagging question about the dollar. I appreciate it.
My pleasure. All right, I'll see you guys this weekend then.
All right, my trading warrior brother, Joseph Wang. Don't forget to catch him this weekend and go to his website, fedguy.com, and learn about, you know, what happens on Jekyll Island, right? And that's a wrap, everyone. You could join the team in about 17 minutes on the morning edge. Good hunting the rest of the day. And remember, don't just count your pips, count your blessings. Adios. See you for TGIF tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.